this on this rainy Thursday, July 8th. Since I think nearly all our registrations are within the US, hope everyone had a great 4th of July weekend. And it's really nice to see activities opening up. We're continuing our series of virtual webinars as physical activities open up, with a view to attracting not only a Houston audience, but a broader audience from the sister TIE chapters in Dallas and Austin. I know that we have a number of you online already, but also across the US. For those of you who are new, our audience this afternoon is largely composed of TIE charter members, and I'll say a bit about TIE in a minute, and a number of TIE general members, as well as a few other people who've signed up on seeing our email announcements or on social media. Now, before I introduce our guest speaker and the topic, I'd like to first acknowledge the generous support of our corporate sponsors. And Soumya, if you would just advance the slide, please. And they're shown on this slide, as well as the TIE charter members. And it's their financial support of our charter members and our corporate sponsors that enable the roster of activities that TIE, the Industry Entrepreneurs, puts on possible. So it's been some time since during these webinars that we've actually given a little bit of an advertisement and information on TIE. So I'm going to take a couple of minutes to do that. TIE stands for the Indus Entrepreneurs. It's a nonprofit founded around the encouraging entrepreneurship in all its aspects. And so we have initiatives around mentoring, investing, incubation, training, education, as well as networking, where we try to bring in people from all walks of entrepreneurship. We have both successful entrepreneurs as well as intrapreneurs in corporations who have become corporate leaders. And they join to give the benefit of their skills and expertise, and now are back to the entrepreneurial community. And we've undertaken a number of physical activities underwritten by our sponsors and the support of our charter members in doing that. And because we've just begun opening our physical events, we had a rather successful networking social last month, and we will have a charter member lunch in a week, which I'll say a few words about at the end of our discussion. I just want to put out a shout out for those of you who've enjoyed our webinars, because we have made our webinars open to everybody, to encourage those of you who might be listening in to either, if you're in a position, to advocate for corporate sponsorship, because we have a lot of worthy events that we're looking to put up, and we'd appreciate the ability to collaborate with the corporate sponsors for whom those interests are aligned, as well as those of you who've thought our webinars have been interesting, informative, and educational. Consider joining TIE. I'll say a few words more about that at the end of the talk and when I introduce next week's event. But now I'd like to just move on to the main topic of our webinar. And for those who don't know me, my name's Ram Shenoy. I'm the president of the TIE Houston chapter, but the star of this show is my colleague, Amy Henry. She's a co-founder and CEO of Unique Ventures, which is a corporate sponsor of TIE Houston. And Amy joined the TIE Houston board this year. Now, it's a really interesting time in Houston in terms of entrepreneurship. There's been a lot of, the landscape has changed dramatically over the last few years. And there's been a lot of media around different things, activities and events around encouraging entrepreneurship that we'll be talking about in this discussion. And Amy has, in her actual role, as well as in her activities in TIE, has been really exhibiting a leadership in all those areas and over the last few years. Amy, for the benefit of those of you who may not already know you, I think it would be helpful if you could tell us a little bit about your previous career and you're one of the few people I know who have simultaneously a finance and legal background. So just give us a little thumbnail about your background.
Yeah, I'm a chartered accountant, CPA. I have a Juris Doctorate with focus on corporate law and tax as well. I have a postgraduate diploma from Oxford, focusing on financial strategy. So my background actually, and this is probably something that you don't even know about my background. I actually started out in public accounting, but even from there, I worked pre-dot-com era with software as a software funded development company, like pre-Google, right? And then from there, I went into oil and gas. So I worked for Royal Dutch Shell for a number of years, both upstream, midstream, downstream, as well as tech ventures, looking at how do we take our R&D and our technology that we've developed, how do we scale it and test it and build out and commercialize, and looking at why do we fail, right? That was part of my job, and where does the value sit? And Petronas, I was their global CFO for their acquisition in Canada, Progress Energy, and they wanted to learn from IOCs and, you know, how do they set up this new unconventional business and going into Argentina and China. And then I was kind of, from my mentor at Shell, I grew up at a time where we were mentored heavily as part of Shell's talent pipeline, was told to go study VCs and PEs, right? And so when I came back to Houston in 2016, so I spent, you know, worked in Holland, India, Malaysia, globally from energy. We started working with the startup community, right? And that's where we saw, you know, the ecosystem, what people were doing, who was actually investing in these companies, right? And we saw this huge gap in the market. So that's kind of how we started Unique Ventures.
That's really helpful, Amy, because you've got a fairly, I think in about 2 minutes, you just sort of described you've been, from the corporate perspective, trying to understand the whole entrepreneurship and value from I would say from a corporate VC point of view, and looking at that. I'm interested, can you tell us a little bit more, as you started Unique Ventures, just talk a little bit more about what's the gap that you saw? And I think this is a rich topic with many aspects. So I expect us to take, you know, maybe 10, 15 minutes on this, but maybe just get us started by your motivation for Unique Ventures and what was the gap. Perhaps start your thoughts on the energy sector where you were concentrating on, but I'll ask you to broaden it out in due course.
Okay, perfect. You can just jump in. I'll kind of start off to my very, I guess, beginning. I never wanted to be an entrepreneur. I'll be very bluntly, okay? I grew up, my father was a serial entrepreneur. So I know what that life is like. I know that all of the ups and downs. I grew up with that. I said, I'm never going to be an entrepreneur. Absolutely, I will not touch it. Because of instability, right? It's tough. It's really, really tough. And then we came back and we're looking at the startup community, and, you know, we had a lot of the, you know, gems, very rough, right? Going through incubation and acceleration, and they were putting the companies in classroom, more classroom based. And I said, really, you know, that's really not what these companies need. And then they get them ready to pitch in front of the angels or VCs, but predominantly VCs. But then, you know, they become kind of like hamsters on wheels, right? They're getting ready just to pitch financially about, I want an investor coming into my company. That's not what they needed. They needed to be working with customers, you know. So, you know, we were like, okay, where are the customers? So we work on the energy side of the business. You know, we should be pairing these companies up with energy companies, right? And working on them, and how do we get them pilots and kind of POCs? You know, we thought the equation was flipped. And we knew how much work this was going to be. We, you know, working in the ecosystem, we tried to get other people like to partner with us. Let's do a pilot of this, right? Let's try a different model, right? Because we really did not want to do this, right? Because it's a lot of work and it's heavy lifting, you know. But no one really was up for it. So then finally we just got so frustrated and we just threw up our hands and we said, okay, fine, we're going to do this, right? So I started to have conversations with Statoil, right? because of their VC, their corporate VC. And I noticed I didn't see them at a lot of the ecosystem events. So I started having a dialogue with them, and this is how we see the gap. They saw the same thing. And we said, okay, can we go around and can we get other energy companies to join this? And so the theory behind it was, can we take companies that are at or close to an MVP, which is a minimal viable product? They have something in hand. They're way past the ideation stage, right? Can we get a small group of energy companies to conceptually agree to sharing a technology agenda, sitting down every year and say, okay, we work with them collectively and individually. Can they find the points where they're going to work on together? Can they agree not to take IP from the companies, right? Can they agree that they're not going to get any preferential rights? This is all hard. The attorneys were just like, oh, this is ridiculous. We're not doing this, right? Can we agree that we can share results from the field trials and allow these startups to say, if I did a field trial with Rochelle, I can say I did a field trial with Shell. So a lot of these companies were stuck with these large master service agreements. Every time they went to work with these companies, they'd be 80-page documents. They're not equipped to do that. And then if they wanted to get some more customer traction, which is what the VC say you want, I won't fund you until I see more traction with customers. So they would do these field trials. And they said, I did a field trial. And they said, who did you do it with? Well, I can't tell you, right? So, they're just going round and round and round. Right. And our industry obviously needs a lot of these technologies and they need to be commercialized. So this is kind of how this started out, was putting it from the standpoint of the entrepreneur, right? How do we help the entrepreneur? How do we help educate them? Working within the energy industry and customers, how do we extend the runway? How do we bring in the right investors to invest in these companies? Because we saw so many companies that were giving up way too much equity in their company, and they weren't going to have much of a company left if they continued. So these were, some of those thematics. And then how do we start to develop relationships and partnerships globally, right? Can't just be Houston, right? It extends at a much wider and global scale, right?
Yeah, that's a pretty rich answer. I think, one thing that struck me in your answer is you identified your gaps by looking at the stakeholders who were not served, right? And so rather than it being a dialogue between entrepreneurs and investors, you correctly pointed out, and I don't think it's only true of energy. I think many investors would say entrepreneurs don't give them enough confidence about customer engagement. And I think the observation you made about giving entrepreneurs the tools they need to get more credibility with customers, which then simultaneously improves their value proposition to investors, is certainly an important thing. And the other thing I appreciated about your answers is how much you touched on several pillars of TIE around giving the entrepreneurs what they need and thinking through, more holistic sense around that. Now, I want to move the conversation a little bit and get you to elaborate on this. And of course, you've been thinking, as it was evident from your first answer, rather deeply about this for a number of years. And in fact, you've been active in a number of sort of public forum in the last, year or 2 years anyway. In fact, you're doing a webinar today, but just yesterday or the day before, you were at an angel forum with a panel of VCs and other investors. Just tell us a little bit about that, and maybe I'll pull one or two of tell me what were the themes that came out to you, and maybe I'll pull some of the questions for the benefit of this audience.
Yeah, I loved yesterday's discussion because I think it was probably one of the really first fun discussions, right? So the thematic was centered around angel investing, right? And we also had some VCs there on it, and it was a small panel, right? So because you need to have these small panels where you can really have these open dialogues, right? And it's also then serving all of these young startups, right, that are attending this this large kind of venture summit, and this particular one was being run out of New York this time. But we had one gentleman from the Harvard Business School, alum of Angels. We had another person from Farsight Ventures. Stan's been a professional angel for like over 30 years and works globally. We had David Friedman from Tech Coast Angels. They invest over 20 million last year and did over 55 deals, right? So these are not small. These are, and we had another angel group from health tech, right? So it came, and I came from energy, right? So we all had these different perspectives, right? And some of the thematics people were, they were talking about, like, okay, number one, what do you look for when you look in the startup? What are some of the qualities? Got into discussions of, will you do a safe note, or are we only do a convertible note? But I think, the really kind of pain point from an angel and some of the VCs was a bit of the complaining about these huge valuations, right? These startups, it's very difficult to work with them. We have to do it, from the angel groups too, we have to do a lot of mentoring. We have to do a lot of education, of these young startups. And we're trying to get them to that next raise, right? That next raise. But they're coming in with these high valuations, and then they see them falling on down this slippery slope, is they're going to have to be raising money again really, really soon. And so they've done themselves a huge disservice, right? So then when they have to go do the next raise, right, by demanding this huge valuation. So, some of my conversation was, I agree, because we see a lot of that. We see that a lot of some of the software and AI digital companies coming from overseas, great technology. But I said, our investment community also has a role in this. We're training entrepreneurs that the way to be considered a success story is to be a unicorn, right? And we've also set this expectation. So we can't necessarily fault the entrepreneurs, right, for wanting to follow that example. Our ecosystem. So whenever someone becomes a deemed unicorn, it's a big rah-rah. But going back to some of the ties foundations, we don't do a rah-rah when we see people become successful small business owners, right? Which drive our economy. It's not good enough to have a solid $20-30 million revenue company anymore, right? So I think we have lots of expectation gaps that we have to fix.
Yeah, I'd like you to elaborate on that. That's an interesting point on the valuation. So, one thing, I think, our audience knows that it's generally true that in the equity markets, it's really difficult for active managers to beat passive managed indices, right? That beating the S&P 500 seems to be almost impossible for, 90% of active money managers, simply because the fees and the burden, and actually just the difficulty of picking the right sectors at the right time, statistically just seems to be too hard, right? So if you're out of the market in the wrong 10 days of the year, you miss 90% of the returns. If you're miss the wrong 10% of the sectors, you also miss 90% of the returns.
Yeah.
And most people are just not smart enough to do that. And it's true of most active money managers. What was really surprising to me, I just never thought about it before, was some of the data you gave me. And, I was reading that actually the same is true of VCs and private equity, that it's really the top 10% or maybe top 15% that have anywhere near the returns that justify the risk they take. And the other 75% or more don't. And it's primarily because I think of what you said, right? That they're looking for these high valuations. They don't diversify. They do the opposite. They can't concentrate. So could you elaborate a little bit on that? And just where I want you to go really is to talk about the opportunity for angel investing and positioning, the fledgling activity that we are trying to organize around Thai Angels, Texas. That's where I'd like you to go. But just tell us about the challenges of VC investing right now, based on what you observe.
So I've been having this conversation because it first started out in Asia Pac, right? And Singapore and those markets. So over there, of course, the VC and PE community is much less mature as it was in North America during that time frame. So, this is the oil prices started going down. energy companies were having to change the way where they're doing business. You had service companies, oil field services were having to change the way. We had oil field services, working with them, trying to raise capitals from VCs and PEs because they wanted to then become an operating company, right? Everyone was changing their models and their approaches, right? But then having these dialogues and discussions with VCs, they said, no, we're going to stick to our same model. And I said, but if all of these people that you're investing in are changing their model and changing their approaches and the way they do things, aren't you concerned longer term, right? At the end of the day, if I decide to go through alternative financing, or if I look for alternative choices, and I'm de-risking whatever investment that I need or want, then I no longer need you for when you want to jump in the game, right? That was kind of the fundamental thesis in question. And it was in my mind kind of when are VCs going to have this inflection point, right? So if I fast forward today, right, and we look at, what happened in 2020, yes, I know COVID and everything, even just look at the history from 2016 to 2020, what do we see? Angels really aren't your traditional angels anymore, right? You've got a lot of, and there's nothing wrong with this. These are just different models. But this is just talking then what gets developed in these capital markets, and how does that change the whole landscape, and where does this provide this opportunity that you're talking about? So last year, of all the funding that went on, 62% of that money went to growth capital. Okay, huge gap. Think, oh my God, that should be a disaster. Well, no, not really, because most of the startups and early stage companies are deferring, and they're revenue positive. They're deferring any sort of financing up through Series A. So that type of financing has gone down from your traditional kind of angel syndicate kind of VC models. And then your VCs they're becoming more like PEs, right? There are very few very niche VCs, very few very early stage VCs that are remaining, right? They're out there, but they're not as many in terms of volume. So you have these huge, large super fund VCs, right? So, you have people like, family offices, organizations like PI that do your angel investing and mentoring, because no one is serving this community. And actually, if you look at those returns, that's really where you're getting that biggest uptake, right? In your returns at the end of the day. And they have the ability to do follow-on investments, right? On some of these angel groups. And they're more able, because a lot of those angel groups are either serial entrepreneurs, successful business owners, corporates. They've got the Rolodex, right? They want to spend time kind of mentoring these companies, In the same way, then the group I left off was family offices, right? Family offices have really, they made their own wealth, obviously, right? And it's about kind of, sustaining it. Some have foundations but they still have to preserve that kind of asset base. And so, they like to pick their own investments. They can't with the VC model, right, anymore. They have a longer staying power. So entrepreneurs would like to, deal with family offices as well. And they're more, they have a higher risk appetite, right, than some of your traditional investors. So you have a lot of different things happening on the scene.
Let me just pick on one thing. I may have missed it, but I just want to go back to VCs. You talked about changing their business model between 2015 and 2020. So you were telling me, I think, of an example where VCs are actually now trying to diversify their revenue streams because their core, they just don't know how to get the core returns, right? And just calibrate us on what are the returns a VC should be getting to justify the risk, roughly speaking.
Well, people aren't going to like me, right? And there's nothing wrong with the model. It depends on what model fits with you. But actually, you need more like a 10x, right? For that kind of risk, right? It's kind of like saying, okay, I'm looking for that unicorn, right? I've got 10 companies, right, that I'm going to invest in. I'm spreading the odds, like from a Vegas standpoint. You don't get to pick the investment. I'm making bets that I know off the bat that 2 or 3 are just going to flat out fail, and I'm good with that, right? Right. I'm hoping one is going to be a unicorn or a unicorn type company, two maybe mildly successful, right? Very maybe 50 million above kind of companies, and then you've got the whole group in the middle. So that's, I mean, that's really kind of what that VC model is looking for, right?
And
It's a huge
10x
risk
over
model.
what period of time are you saying? Is that over 10 years, 10x over 10 years, or 10x over 5 years? Or
Well, I mean, theoretically, they'll tell you their model is a 7-year model, right?
okay.
But for the most part, most VCs will want to work over that 3 to 5 year period, right, where they want to exit, right? And the reason why some of their LPs and investors have kind of fallen out of this is because of that the management fees, right?
Right.
So they're getting management fees, year on year on their capital,
Right.
right?
I did forget to our audience that if you have questions, and I see one on the chat, please put them on the chat and I'll do my best to incorporate them. So there's a question of clarification, Amy, which is 10x on an individual investment or across a portfolio?
I would say across the
portfolio,
portfolio, right? And it's
Yeah.
a question of how diversified that portfolio is, right? It'll vary from from VC to VC. But if you take there's lots of people who've done studies on this, right? If you've invested in the S&P or New York Stock Exchange, you actually will end up better returns, right? Than the VCs historically, right? And so we are seeing VCs looking and they're looking for other sources of income to create, if I look at the profitability, just to bump up their profitability margins by even 0.5 or 0.6%, right?
Yeah, question of clarification again from Donald, which I think we did mention before, but how many VCs actually achieve that over multiple funds?
No, not many.
Yeah,
not many.
It's less
Not
than
many.
the top, it's within the top 10%, right? Of VCs.
Yeah.
90% don't make it.
Yeah. Oh, and the reason why they do make it is because of the management fees every year, right?
Right.
And so those management fees cover, their operating costs. So it doesn't matter if they completely bomb on their entire investment thesis, right? All that capital that they're holding, right? They get a management fee every year, right? So the question is we're asking entrepreneurs to deliver on their promise, right? And if they don't, there's consequences, but the VC model works very, very differently.
So your point is that the landscape is ripe for changes in business model, and there is a need, and it's shifting.
I'll just quickly read. I mean, just three headlines. Just of the last 3 weeks. Is a VC bubble? Is it the new normal? Right? Forbes. Are we in a VC bubble? Right? Does tech need a new narrative? Example. Another one is unicorn VCs aren't a reliable predictor of success in technology, right? These are with the last month or so. So, I mean, it is being talked about, right? And then you throw in all these new investment vehicles. So,
right. So I want to move on a little bit and get us to talking about the opportunity for angel investing. But I think another ingredient about this is, let's just talk about how Houston has changed and what's published in the media versus reality. And you had a couple of interesting observations about the amount of funding, VC, just funding for startups, and how it's reported as increased over the last 2 or 3 years. And also you had an observation about startup formation in Houston. So would you just care to enlighten us on that?
Yeah, it's kind of what I tell my kids, my kids are the TikTok generation, right? Like, you can't believe everything on TikTok and Instagram, right? You have to look at the underlying numbers, right? And it's easy to take numbers and think, okay, so if you look at the reports and say, yeah, Houston's doing a great job. Now, don't get me wrong. It's going to take a long time. Houston's an early stage ecosystem, an innovation system, right? It is going to take them a long time to do this, and they are making steps in the right way. However, when we start counting VC numbers, you have to look back and say, okay, you have to look at inbound and outbound. How much of the activity is happening inbound with our own VC and investment community? Not a huge amount. We've got huge outbounds. We've got people coming inbound, right, into Texas and into Houston and other markets, right? And the question would be kind of why? Discussions I've had previously is, all the investment community here would love to expand their funds, but the comment that is being made time and time again is we just don't see enough investable startups in the community, right? And then we have the issue of the startups, or what people are calling startups aren't startups. I mean, this is a discussion I have with our industry partners. You know, go and take a look at, you see people that are being touted through the various, you know, accelerators or, you know, ecosystem. Because they're like a Series B. This includes Series B funding, right? And so, you know, we really need to split that apart and say, okay, what funding is actually going to very, very early stage companies? You know, really where this big funding is going is these companies been around for 7 years, 8 years, 9 years, 10 years, right? Yeah, you have a few outliers, right? But what is being funneled into that early stage, right? Where you need to start planting those seeds is not happening at the scale it needs to. Right.
Excellent. Before I get to my next question, actually, I want to incorporate a couple of questions from the audience again. So Somesh asked, doesn't the 2 and 20 model align investor and GP interests? And GPs do not make much money until they return investors' money. Doesn't that, I'm paraphrasing here, isn't that a good model for the limited partners? And perhaps you might explain for the audience, some may not know what 2 and 20 is. So if you just take a minute to explain that too, please.
Well, I mean, just very simplistic, you know, and there's different variations, right? Is 2% is that I just think of it as a management fee, right? It's a management fee that I'm charging
2%
you, right?
of assets.
Yeah, of your assets under management, right? The 20% is going to be my carry, right? As that portfolio manager, I'm a VC and I'm managing that, right? I'm not injecting any money in, but I'm getting carried basically by those LPs who are investing in that fund.
So
yes and no, it depends on what your expectations are, right?
Yeah, let me just like you to clarify, because some may not understand the terminology of carry. So that means that 20% of the profits above a hurdle rate go to the VC, not to the investor.
Correct.
Okay. Please go ahead. Sorry to interrupt.
I mean, it depends on what you're looking for and how you're trying to manage your portfolio, right? And then you and I have kind of had this discussion, right? I mean, you know, some people like that model, right? You know, they're comfortable with it. You know, from an LP, you know, but I think more and more people want more control over their money. They're looking at performance. I have personal friends that have traditionally been LPs and VCs, and they're choosing not to continue those investments. This last year, several large VCs are having really trouble raising funds for their next fund that they're raising, right? Because of that. So, I mean, it depends on what you're expecting in terms of your return, if you know, and how you want to control your money, right? And where you want to see your money being injected. What happens if I don't agree with the area that you're going into? I really don't have a say, right? At the end of the day.
Right. Let me put in the other question from Jan, which is, so you've talked a lot to entrepreneurs. So what do you recommend is the process for entrepreneurs to reach and select strategic VCs as investors then?
Well, I mean, and this is why I think it's really important for entrepreneurs, right? To have mentors, to have very strong mentors. I mean, even at Unique, from day one, when we start talking and working with we're not charging startups anything. I mean, what we're doing up to pilot, it's free, right? Is this dialogue, right? I can't inject what I think, you know, what a good investment partner is for you, right? I have to understand kind of the way you think. I have to understand your strategy. I have to understand what technology are you in, where your stack is going to be, who are going to be your real customers and let's have this discussion and understand kind of from you, what are your drivers as an investor? It is like a marriage in some instances, right? Where you have to marry up. You know, not all investors are created the same, nor are the people in those VCs are the same, right? And so you've got to figure, do I need a corporate strategic? Those are going to be where you have, you know, really game-changing technology. You know, they play a very important role in getting that development. Do I see myself exiting very quickly, right, and fast? It depends on what markets do you want to go to. It actually, you've got to go through that list and have this discussion. And there's no one process, right? There really is no one process for picking that select strategic VC. And then you have macro VCs. You have VCs that only deal in digital. I'll have VCs that only deal in IoT, VCs that only deal in healthcare, right?
So you've covered, some of the challenges, this fixation on maybe looking at really high valuation startups and ignoring, shall I say, perfectly respectable, profitable businesses, but which aren't unicorns. You've identified that as a gap, right? That those businesses just don't make it because VCs are looking for the unicorn and they tend to pass on those. You've talked about startup formation and the fact that the ecosystem, at least in Houston, isn't providing yet, or people have not figured out a way to provide enough investable startup deals that investors perceive. That's another opportunity. You've talked about the needs of stakeholders. So you very early on talked about, well, no one's helping the startups with customers. No one's mentoring the startups. They're all just talking about money and how to rehearse to win more money, but not actually how to operate a business. And you've been trying to meet all those needs. So sort of synthesize all of that into what do you see as the angel investing opportunity? Because you and a number of colleagues at TIE have been thinking about what is the positioning of a TIE Angels Texas activity. Just begin synthesizing that for us, for this audience.
And before I do that, I don't think, I'm not going to let the startups and entrepreneurs off easily. So it's not, I'm here to saying rah, rah entrepreneurs. We all, at Unique, we say, okay, Unique means good victory, right? It's about the entrepreneurial spirit, right? But at the same time, that means that we have a fiduciary duty to the entrepreneur. And so we have to have really honest and tough conversations with them, right? And we have to push them, same way that we push and pull our energy partners, right? So no conversation is off limits, for the entrepreneurs. But it's a question of how do we breed good quality startups, right? At the end of the day, and all of the companies, and this is, we work globally, so we deal with Canadian companies coming down, companies from Norway. We work with Business France bringing their startups over here, Asia Pac. And at the end of the day, all of these startups are looking for what they call smart capital. And what is that, right? And this is a younger generation too, we need to understand too. The age demographics of startups have changed, and so have their experience levels, right? So, previously, a lot of the startups in energy, they would have worked in different areas within an energy company that came out from energy, right? And would have that breadth and depth. Whereas these younger startups only have the depth, right? So they need this mentorship. So they're looking for people who can mentor, enable, kind of help them figure this out, right? And partner with them, right? So it's no longer good enough that, you're a VC and I'm willing to write you a check. The question is, what are you going to do for me besides the money? That is so they are actually kind of flipping the equation a bit and says, what is your value proposition, right? And energy, we always ask, what's the customer value proposition? That's always this big topic. Well, this is what entrepreneurs are asking, right? And this is how they're comparing these VCs, right? And they want to see how they have enabled these other VCs. So they want people that will and have the experience and the Rolodex, right? And that really is what they're looking for. We look at companies, and we probably, our assessment factor of whether we're going to work with someone, we probably place 60 to 70% on the team at the end of the day, right? Because we see this as developing that personal relationship. And the thematics of TIE and other organizations like TIE is, we spend a lot of time with TIE, from the university. How do we create the future entrepreneurs? We focus on the diversity factor, providing those opportunities for women. And we have a lot of members that, want to mentor and kind of pay it forward. Those are things that can create a lot of value, for these startups, and that they welcome, right? They really welcome.
Very good. I'm going to ask you to elaborate on this, because you answered about the entrepreneurs, but I'll ask you to now synthesize it. But I've got a few questions that I think we should clear first. I think we have well, it's not surprising, we do have entrepreneurs in the audience, but Jan is asking, how does an entrepreneur reach out to California Sandal VCs with, I guess he or she has a new software platform to broaden the options for the entrepreneur? So I'm envisaging something that's a competitor to Gust or AngelList or something like that, right? What would your answer be there?
Oh, difficult, right? So what we try, what we try to do, okay, listen, at the end of the day, I would say half of my time is just mentoring people, right? I would say the other quarter of my time as CEO is providing those connectors for people, right? Because we have a vast and wider network, right? So we work heavily with the Silicon Valley. I've got Silicon Valley VCs reaching out to me now every week, right? Looking for good quality startups, right?
Right.
So it's really finding people that are doing the pay it forward, and
right.
Actually, and there's a lot of niche. If he wants to talk to me offline, yeah, we can help him. Yeah.
Okay. Actually, you mentioned something which I think I understated in my questions, but you really should. I think it deserves more attention. So let me ask the question, right? So several times now you've mentioned your connectivity across different geographic regions, right? With Asia Pac, Canada, and so on. And I know you've got just talk a little bit about the relationships you're building across different country regions, and how you're using that to build not only networking, but also either bringing startups to markets or investors to startups, or vice versa. Or just talk a little bit about that, because I do think that's something that has some synergy with the Global TIE organization, the Global TIE Network. And I think it's something you've done very naturally over the last 2-3 years.
Yeah, and it's nothing that I say, oh, we want to do this because we think it's sexy and glamorous, right? If you look at the energy industry, right, it was first looking at, we've got to create these energy bridges, right, between these key markets. Being in North America, okay, Houston and Calgary is that natural market. We were having these Canadian companies all come down to Houston, right, because they didn't have our model up in Canada. But historically, we work with the Council General, trade organizations that are there for business development. How do they export those technologies out and get into the future market? We work with kind of DOE equivalent, Department of Energy equivalents up in Canada, because some other countries have better grant mechanisms, right, and non-dilutable funding for startups, right? And they are now reducing those requirements where you must be a Canadian-only company, right? And so it is, people essentially, I try to tell startups, it's a global competition for talent here, right? Everyone is trying to entice these technology companies, and they're looking for foreign direct investment in the economy and things like that. But at the same time, we see a lot of great technologies, but they're one-pointed solutions, right? It's like, I like this one here, I like this one over here. They may be in 2 different countries. How do we create these collisions, right? And actually, really create a more, I'll call an integrated solution, right? That, a customer will adapt, correct? And so it's also important for people to see what is being developed in other countries, right? And with COVID, what it ended up being is North American companies, actually, when we screened through our over 1,000 companies last year, predominantly the majority of those companies were the international ones that made it through the cut, right? It's just, you didn't see that, right? But by opening these markets and pathways, right? You can learn from each other. A lot of these startups can really learn from each other, right? Just by sitting in one market, you really don't know. And there's things great about the US. Norway also heavily, invests a lot in their startups. We also have been having conversations with Subsea and Energy Valley. They're relooking at things like, do we still want to go with the Techstars model that takes a lot of equity from companies? Can we look at doing this differently? It's pairing up all of these conversations, and it's really people, looking for smart money, extending the runway for the companies, getting commercialized companies that can get into international markets. But this takes time. I mean, this is not easy. Okay, right. This is like it's like herding cats, right? And trying to get people, and not everyone's going to get it, and they don't. I would say 90+%. They'll cooperate, but collaboration means something totally different. And also, what I encourage startups to do is, it doesn't matter people don't get it now. You have to always leave that door open, right?
Right.
You always have to leave that door open in doing this.
So I want to just clear a couple of other questions. So Ravi asks, how should investors and mentors help higher education institutes like Houston Community College, Rice University, U of H, University of Texas, Austin, whatever, right? Build better entrepreneurs, build a better pipeline of innovation through the college system?
Yeah, I mean, and we do a lot of work, and we partner, and we're big fans of Rice, right? But we do not do a good enough job in recognizing the great programs that have come from our community college systems here, between HCC, Lone Star, but we have other universities here in Houston too as well. Right. And so we all kind of forget about that. And because it's not talked about, then, well, a lot of the young startups, compare Silicon Valley is they like the community aspect, right? There's a community support one another, right? And because people don't know about these avenues, we don't have our business people or others working with the smaller and more local universities to donate some of their time.
Right.
And we need to have more of it.
Right? We'll come back to that in a minute. Jan asks, is there a route to seek investment managers from the Gulf states? I'm assuming the Middle East.
Yeah, I was in the Middle East, right? And we've had a lot of reach out from the Middle East, right? And just from an energy perspective, right? Really getting into the innovation and acceleration, especially on the clean tech, as well as water and some of their other issues that they're facing, and trying to wonder if there's, they're looking at for a pathway into the Middle East of technology companies, right? And we've had a few that went over to the Middle East as well. So that's another pathway we've got to work on building.
And then it's not a question, it's a comment, but I think I'll read it out to just have you have a reaction. So Somesh just provides a comment saying, what should be considered smart money should be operating excellence, guidance and scaling the entrepreneur's business, and helping with strategy development. All of those are key requirements to be considered smart money. Would you care to build on that? Or?
Oh, yes, I do, because that reminds me, thank you, Somesh, because there's one thing that we talked about yesterday in the panel session, and I loved it from the energy. We're all about stage gates, right? And we're all about outcomes. I would say sometimes you probably overdo it a bit with the KPIs. But what I found interesting was the question was raised for the angel investors. Are you starting to, when you invest in companies, tie that to actual deliverables, right? Which I have not been raised in an angel and investment community before. So, that gives, I think that's a good sign. We do, of course, right? Because, we think that's important, that the operational excellence, right? It's not that you're there to hit them over the head, but you need to have a delivery. They're going to have to deliver against a certain timeline and operational excellence and how they scale up, right? So we need to see more of that done.
Excellent. So now let me ask you to come back and synthesize this all, because you talked about the entrepreneur before. So just talk a little bit about, so how do you pull all of this together and say, what's the opportunity for the Thai Angels Texas investing, and we're in like the last 5 to 7 minutes. So this will probably be our last question.
Well, I would say it's, as these companies and startups and I use the word startups very loosely, right? Because we even deal with Series B and Series C companies, right? People have to understand with the clean tech, startups, clean tech companies may be at Series B, but they're only at a technology readiness level of 5. They haven't even piloted their technology, right? So, I mean, the spectrums have really kind of changed a lot, right? For these startups. But what was I going to say? What was your question again? I got off my little tangent here.
Bring it all together and synthesize this into what's the opportunity for
on the opportunity.
Okay.
So what they want is they want their financial partner, an investor that is going to have experience in that technology, or they're looking for experienced entrepreneur. They need a lot of these companies, and this is as of late, where we need to bring in someone as an interim CEO, for example, and those are some of our angel investors, right? Or they're looking to add them to an advisory board, which goes with a mentoring and opening up to provide that investment capital for them. Whereas if they just look at standalone angels, majority of the startups that we talk to aren't interested, right? I don't want the headache. I don't want the hassle. I don't want to deal with, if it's just, standalone angel, I don't want to deal with 5 or 6 people. If it's just a pure angel group, well, that's great, but I don't see them really spending a lot of time with their portfolio companies, right? These are the conversations that we're having. If I look at some of the big programs like Techstars, the complaint is, I got some money from Techstars and the like, great, they got me to the point, but I get dropped off at the point of adoption. Now, who's here to help me get me through this valley of death, right? So it's they're kind of re-looking at who are the optimal investors, and this is where really an angel group like Thai comes to the top of their list, right? And especially with their global connectivity.
Yeah. One final thing: how do you get angel investors to not succumb to the VC thing of just looking for only unicorns, and just calibrate them on investment expectations?
Because I think what you got to do is, I think each of the chapters, we've got to make sure that we have someone from each of our chapters, right, that represent a different perspective, right? So we have people that are just there. I just want to invest. I'm looking for returns. I'm here as an investor. Whereas the other one says, you know what, I'm a feel-good investor, right? I'll see something and it's a community thing, or they touch my heart on what they're trying to do. I'm going to invest, right? The other one is, I want to invest in female startups, right? To help scale up women-led businesses. So you need to have all of those people involved in this, so you don't lose all of these perspectives. It's diversity in thought. You got to maintain that diversity in thought in your angel investment community, right?
Well, thank you very much, Amy. That was really a pretty rich conversation, and I'm glad that we recorded it, because I'm sure there'll be many more really who want to listen to your insights here. This was very good. Samia, so first of all, thank you so much for your time. I think I learned a lot about you that I didn't know before. So this was pretty illuminating, and look forward. I'll just say Amy and other colleagues are sort of working pretty hard on rolling out this Thai Angels Texas initiative, and we'll have some forthcoming announcements and information on that in the coming weeks. So with that, Samia, could you put on the final slide, please? I just want to talk about our next event, which is an in-person event. It's a charter member lunch on July the 15th at Houston Community College. It's really about fostering entrepreneurship at the college level. We'll have students from the earlier this year Thai University's Hackathon and Pitch Fest, and we're really looking to That was a very successful program that we conducted this year. We're looking to prepare and take it to the next level for next year. And the charter member lunch will be led by Ravi Brahmbhatt, who's been our Thai board member leading this, and he'll give a talk about this. Please join us. And those of you who are not in Thai, please consider joining Thai as a charter member. We'd love to have you. We're going to have a fairly rich calendar of physical events forthcoming. And if you're with a corporation, consider sponsoring us. Reach out to one of us. Samya San, our executive director, is the lady who keeps all the trains running for Thai Houston. Thank you so much, Samya, for organizing this. And by the way, she's in India right now, making sure this webinar goes through. So really you're going above and beyond. Thank you so much for all that you do. And with that, thank you again, Amy. This is really wonderful. Look forward to seeing everyone, hopefully next week in person, and maybe at our next webinar in a few weeks. Bye.
Thank you. Thank you.